Imagine building a financial machine that literally prints over $1 billion in pure profit in a single quarter, completely upending a massive banking oligopoly. And yet, some of the smartest money on Wall Street is absolutely terrified of your stock. That is the exact paradox surrounding Nu Holdings right now. It's an absolute juggernaut, a cash-generating engine, and yet there's this massive, hidden tension brewing just beneath the surface.
And just to prove this isn't some theoretical hype, look at this. $1.1 billion. That is the staggering net income Nu just reported for the second quarter of 2026. I mean, this isn't some speculative fintech burning cash for growth anymore, right? This is a company producing massive, undeniable profits. But despite this monumental beat, Wall Street analysts are fiercely divided on what happens next. So what exactly is the market seeing that has them so on edge?
To understand why smart money is sweating, we first have to pop the hood and understand how this machine actually operates. Now, Nu is a branchless, mobile-first financial platform, and it has completely disrupted the highly concentrated, rigid, traditional Latin American banking sector. For decades, the legacy banks down there essentially operated like a cartel. If you wanted a basic checking account in Brazil, you were forced to wait in physical lines for hours, pay exorbitant monthly maintenance fees just to let them hold your money, and deal with absolutely atrocious customer service. Nu stepped into this massive void by offering zero-fee digital checking, credit cards, and personal loans right through a beautifully designed app. And the total addressable market they're capturing? It's staggering. Nu currently commands 139 million total customers. Just pause and think about the sheer size of that user base. 118 million of those customers are in their mature core market of Brazil. That's over 60% of the entire Brazilian adult population using a single banking app. And having essentially conquered Brazil, they're now aggressively pushing into their primary growth frontiers. 16 million customers in Mexico and 5 million in Colombia. They are rapidly capturing massive swaths of the unbanked and underbanked, people who were just entirely excluded from the formal financial system by the old guard. And this brings us to their ultimate superpower. Because Nu is a cloud-native, fully digital ecosystem built completely from scratch, they don't have thousands of physical brick-and-mortar branches to maintain, no armies of tellers, no decades of legacy mainframe technical debt slowing them down. As a result, their average monthly cost to serve an active customer is roughly 80 cents. Compare that to the $3 to $4 it costs traditional legacy banks. That 80-cent cost structure isn't just a slight edge, it is completely devastating to the competition. It fundamentally changes the break-even point for a customer. A legacy bank simply cannot afford to service a low-income consumer with a tiny account balance because the overhead just eats the margin. But Nu can. This structural advantage allows them to remain highly profitable while simultaneously offering much more competitive lending rates and higher yields on customer deposits. It's an architectural moat that legacy banks literally cannot replicate without tearing down their own physical infrastructures and firing tens of thousands of employees, which, let's be honest, just isn't going to happen.
Okay, so the engine is beautiful, and the moat is incredibly deep. What could possibly threaten a company with 139 million users and an insurmountable cost advantage?
Well, this is where we hit a massive market disconnect. You have major Wall Street analysts giving Nu a $22 buy rating, modeling incredible growth, while others are slapping it with a $10 sell, anticipating a complete structural breakdown. As of right now, Nu is trading at a forward price-to-earnings multiple of about 13.3 times. That is a huge discount compared to traditional high-growth U.S. consumer fintechs like SoFi, which trades closer to 25 times forward earnings. Wall Street is applying a heavy discount on Nu, and it all comes down to emerging market risk and the terrifying prospect of a Latin American credit cycle collapse. The entire bear thesis is perfectly summarized by this single figure, 6.9%. That is Nu's 90-plus day non-performing loan ratio as of the recent quarter, and it's been steadily creeping up. You really have to remember the macroeconomic reality of the Latin American consumer. This is a region historically plagued by hyperinflation, severe currency devaluation, and incredibly high localized interest rates. Wall Street is terrified because Nu is actively shifting its business mix. They're moving away from just offering high-volume, low-margin transactional accounts and pushing aggressively into higher-yield, unsecured personal lending. Unsecured lending is incredibly lucrative during economic expansions, sure, but it is deeply dangerous during contractions. The fear is that if inflation spikes again, or if central banks are forced to keep interest rates punishingly high, the fragile Latin American consumer will simply break. If that happens, that 6.9% default rate could explode into the double digits, wiping out Nu's profitability and severely impairing their capital base. But let's look at the hard evidence to see if that fear is actually materializing. Let's dig into the Q2 2026 earnings, which were reported on August 13, 2026. Nu absolutely smashed expectations across the board. Top-line revenue came in at a massive $2.8 billion, beating analyst estimates easily. Earnings per share hit 23 cents, sailing past expectations. And that $1.1 billion in net income significantly outpaced the consensus of $941 million. But more importantly for the bears, who are hyper-focused on loan defaults, the cost of credit actually dropped 9% sequentially to $1.7 billion. And early-stage delinquencies, the 15 to 90-day NPL ratio, which is essentially the canary in the coal mine for future bad debt, actually improved by 16 basis points, dropping down to 4.8%. This report dramatically stabilized the stock, proving that a massive provision build they took in the first quarter was likely just temporary conservatism rather than the beginning of a systemic credit collapse. In fact, CEO David Velez addressed this head-on during the earnings call. He essentially said, "Look, generating over $1 billion in quarterly net income proves the profitability engine is no longer a hypothesis. Management is making it very clear that the core business is incredibly resilient. They attribute their ability to navigate this tricky credit environment to their proprietary AI credit scoring engine, known internally as Nu. Here's why this matters. Traditional legacy banks rely on outdated, centralized credit bureaus, like a FICO-style score, to decide who gets a loan. But in Latin America, millions of people have thin files, meaning they don't have a formal credit history at all. Nu's AI engine ingests billions of proprietary data points from how these users actually interact with the Nu app, their spending habits, and their transaction flows, to underwrite credit natively. Management is arguing that their machine learning models are just fundamentally superior at managing risk than anything the legacy banks have ever possessed.
Now, we've seen the quarterly numbers, but let's step back and evaluate the underlying architecture of this franchise.
What's really interesting here is how consistently strong Nu rates across the most critical qualitative metrics. Management alignment is a stellar 9 out of 10. David Velez is a visionary founder-CEO who has actually signed the Giving Pledge, which ties his long-term legacy directly to durable value creation rather than short-term stock pumping. Capital allocation is also a 9 out of 10, which is exceptionally rare for a hyper-growth company. A 9 out of 10 here basically means they aren't just setting cash on fire to buy market share, they are highly disciplined. They recently initiated a $1 billion share buyback program to offset employee stock dilution, all while generating enough internal free cash flow to aggressively fund their expensive Mexican expansion. Combine that with a 9 out of 10 for a virtually unassailable market position in Brazil, and the blended qualitative score sits at a massive 8.6 out of 10. This is a remarkably high-quality franchise operating at the peak of its powers. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Speaking of deep research, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Premium also gives you Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's model this out. Where could this stock actually go over the next 5 years?
Before we dive in, I need to be super clear. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. This is strictly a framework based on operational assumptions.
The crucial point here is understanding the operational reality that has to happen for each case to actually come true. Let's start with our bull case. For Nu to hit $45 billion in year 5 revenue, which would be a massive 35% compound annual growth rate, they have to flawlessly execute their expansion playbook. This assumes they fully monetize their Brazilian user base by cross-selling high-margin personal loans and investment products while simultaneously achieving absolute dominance in Mexico and Colombia. In this scenario, their AI underwriting proves superior across all borders, pushing net margins to an incredible 38%. Recognizing this moat, the market re-rates the stock, awarding it a premium 22 times PE multiple. In our base case, we see steady, predictable Brazilian monetization and disciplined, albeit slightly slower, expansion abroad. This drives $36 billion in revenue with a highly respectable 33% margin and the more conservative 18 times multiple. But we have to look at the bear case, and the landscape here is brutal. This scenario assumes a severe, prolonged macroeconomic recession in Brazil. Credit defaults spike, forcing Nu to aggressively pull back on lending. Simultaneously, their Mexican expansion stalls out as local competitors outspend them on customer acquisition. Revenue growth slows to a sluggish 15%, credit provisions compress net margins down to 25%, and Wall Street punishes the stock, shrinking the valuation multiple down to a highly defensive 12 times.
When you run that operational math against the current baseline share price of $13.56, you see a massive divergence in implied prices. The bull case implies a target of $79.20. That is an incredible 484% total gain, which translates to a massive 42.4% annualized return over the next 5 years. The base case points to $44.64, representing a very strong 26.9% annualized return. But that bear case drags the implied price down to $15.36. Because of multiple compression and slowing growth, that represents barely a 13% total crawl over 5 years, or a meager 2.5% annualized return. It effectively becomes dead money.
If we apply subjective probability weights to these outcomes, say assigning a 30% chance for the bull case to play out, a 50% chance for the steady base case, and a 20% chance of the bear scenario becoming reality, we arrive at a weighted expected valuation of $49.15. What this calculation reveals is a highly asymmetric, risk-adjusted return profile. The potential upside, if management simply continues executing on their current trajectory, heavily outweighs the downside risk at current valuation levels. And remember, you can tweak all of these exact assumptions yourself to fit your own thesis by accessing the full free model over at flash.stocksentinel.ai.
But what about that 20% bear case? Let's talk about the risks that could actually break this whole thesis.
We absolutely cannot ignore the possibility of failure, because the risks here are severe and they completely validate Wall Street's fear. These are the concrete early warning signs you have to watch. First, replicating their Brazilian success in Mexico is far from guaranteed. Mexico historically has much lower digital banking adoption and a heavy reliance on cash. If you see customer acquisition costs heavily spiking in Mexico, it means the playbook isn't translating as easily. Second, their proprietary Nuformer AI credit models look fantastic in a benign, growing economic environment. But the hard truth is they are relatively untested in a severe multi-year regional credit crisis. If 90-day NPLs start breaking above 8.5%, it's a massive red flag that the AI models are failing to predict borrower stress. Third is macro currency risk. Since over 60% of their revenues are generated in Brazilian reals, the stock is highly sensitive to foreign exchange volatility. If the US dollar strengthens violently against the real, Nu's earnings just look significantly worse on paper. Add an intense, aggressive competition from e-commerce giant Mercado Pago, who is fighting tooth and nail for the same digital consumers, plus growing regulatory scrutiny as Nu transitions from a scrappy startup to a systematically important regional bank, and you see exactly why the bears are vehemently holding their ground.
It really all boils down to this: the growth dilemma. Nu has built an incredibly safe, highly profitable cash cow in Brazil. But with 60% market penetration already achieved, that core engine is inevitably maturing. You can only bank so much of a single country, right? To justify the long-term growth story and the multiple, management must take the billions in profit generated from the safety of Brazil and actively transfer that capital into the intense execution risk required to win in Mexico and Colombia. It costs far more capital and energy to acquire a skeptical Mexican customer today than it did to acquire a Brazilian customer 5 years ago. It's essentially a massive capital transfer from a safe haven into a war zone.
So, weighing all of this, the massive economic engine versus Wall Street's completely justified fears, where do we land? Here are your 3 definitive takeaways. First, that 80-cent cost to serve is a genuine, structural, technological moat that legacy banks simply cannot touch without destroying their own businesses. Second, while Wall Street's terror of a Latin American credit cycle breaking is a valid historical concern, the data suggests that fear is already heavily priced into the discounted 13.3 times forward PE multiple. And third, because the upside growth vectors in new markets are so potent, Nu ultimately presents a highly favorable asymmetric risk-reward profile for patient capital willing to ride out the inevitable emerging market volatility.
But if there is one single thing to watch next, the ultimate operational catalyst that will determine the next 5 years of share price action, it is this. Can NUA achieve the exact same high-margin monetization with their new customers in Mexico that they perfected in Brazil? If they do, the bear case completely crumbles.
If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.